Today, folks, we're barreling toward one of two crazy outcomes. The first, tariffs get implemented, causing extreme economic uncertainty, which would fuel the perpetual sell-off we're experiencing in the market as of this moment, as people sideline to see how this kind of permeates and affects everybody. Or the second outcome, the Russian roulette game continues. Trump pushes tariffs off for another month as Canada and Mexico actually strengthen the border, if that is the true underlying reason of this tariff war. But what I do know is the markets do not enjoy this. And in fact, I think we're just experiencing buyers exhaustion. I mean, even Trump announcing, offering the crypto reserves in the United States, announcing Bitcoin, Ethereum, all that stuff. It rallied a little bit, but then it sold off pretty hard going into this news, right? And I think what we're seeing is the market's just struggling to keep up to these all-time highs. With the S&P 500 right now, the price to earnings actually dropped below 29, as I think most of the momentum stocks where people were really chasing that escalator up are now experiencing the elevator down, because it's not all stocks getting hit equally in this sell-off. But even after a year, with the S&P up 14%, we are now seeing it go negative for this year specifically. And we're going to compare this to the Canadian markets. We're going to look at a bunch of stocks, ones that I want to buy as I finished up my taxes. I'm waiting for my tax returns. I would be buying this today if I had a lot more liquid capital, but I will be buying this week, and I hope we see a continued sell-off. Now, I'm not excited for the effects of a full-blown tariff war, but unfortunately, these economic uncertainties, if you're a long-term investor, are just a window to buy. So if you're on a path to financial independence, if you want a place of solidarity where your emotions don't need to get all over the place, join me. Let's do this financial independence journey together by simply hitting that subscribe button. Because if we look at the S&P first and foremost, and then we'll look at the Canadian markets, it's mostly tech, right? With the exception of Apple actually not getting hit that hard. It's the really high-flying stocks like your Nvidias, your Palantirs. I mean, Google, Meta actually continue to pull down. But if you look at the rest of the market, I mean, healthcare is doing great. Consumer staples, things like Procter & Gamble, Philip Morris, your sin stocks, with the exception of energy, maybe some specialized industrials, the market is still in a fairly good place overall. I mean, look at something like Nvidia here. That I don't want to say it was a pure momentum play, because the valuation actually isn't that bad if you believe in the growth going forward. But to see this wicked sell-off after those astounding earnings is even a shock to me, as we head toward a valuation that's more in line with Apple's. But the chip sector as a whole has been just getting clobbered, because again, I think this is like buyers exhaustion. It doesn't matter that the earnings are good and the fundamentals are starting to make sense. People are just, they've flooded most of their money in here, and now that there's fear, it's the first thing they want to get out of. And obviously there's some concern too with Trump tariffs. He's been talking about trying to bring chip manufacturing back to the United States. The chip ETF as a whole, Vanatech semiconductor ETF, is down 8.9% this year. Software companies, like I said, if you've taken the elevator up for the last 2 years, now we're going to start seeing, the escalator up, the elevator is going to start taking us back down, right? And these are companies that have been trading at nosebleed levels. I'd call those companies like Palantir, Tesla. People are sitting here realizing that the growth in this company is purely in speculative insanity, up in the heavens. Everyone's floating around in the atmosphere when it comes to the valuation of a company like Tesla and Palantir. And I think these are the stocks that really need to see the heaviest hits before, we can be back to a place of what I would call normality in this market. I mean, we've been seeing it, right? Crypto, speculating on these pump and dumps. I mean, there's so much going on that really shows that we are in an incredibly speculative market. And we need these hiccups to remind people that, hey, there's a lot of people speculating, and they're the last in, usually in the first out, and that's probably what's happening here, right? But if we take a look at companies like Google, I'd be buying these every day of the week. I hope Google goes back below a 20 price to earnings multiple. As I said, if we can get to 150, 160 range on Google, man, what a dream. I can't get over a company like this that has the growth rate it has right now, is trading at a 21 times. But I will pick this up if it stays down here by the time I get my next check, which will be this week, and hopefully that tax return this week as well. That would give me a good amount of ammo to start unloading into this market environment. If we switch over to the Canadian markets, however, the Toronto Stock Exchange has actually been holding up better than the U.S. markets on the 1 year, slightly better performance, especially if you include that dividend. And I'm shocked that heading into this tariff war, the Canadian markets are holding up as well as they are, because we will be in a recession. But keep in mind, not all these companies are going to be affected equally, and we're going to talk about that real briefly here, because today we are seeing some pretty big sell-off in tech like Shopify, Constellation. Canadian National Railway has been getting hit a little bit hard here. Actually, most of the Canadian markets, especially energy like C&Q, is down quite a bit here. And if we take a look, Canadian National Railway, is down 2.85% year to date. Enbridge is actually starting to rally back from its sell-off, flat on the year. And I'm shocked, again, that this stock hasn't sold off more, even though the CEO said, hey, Everyone's going to have to pay for the tariffs across the board, the companies, the customers, all that stuff. But these massive utility companies, I think people are realizing are almost a safe haven. And I would call safe haven companies even still perhaps like, I don't know about energy specifically with the direct oil companies because that's the biggest trade partner with the United States is energy. So this one I'm curious by. But when you look at things like Waste Connection, companies that, regardless of what tariffs do, I think are going to largely be unaffected. The utilities are still really strong. Hydro One's actually up 5.5% this year. And you see that, right? Like Fortis is up. Amera, a couple of these companies are doing pretty well. Companies that I personally like that I wish I owned that I don't currently. But when we take a look, I mean, still, I think you're better off owning mostly U.S. assets because as continued fear bakes into this economic circumstance, this happenstance that we have to live with, our dollar continues to get absolutely wrecked. And as much as fun as it is to own Canadian stocks, I don't like thinking that, oh yeah, my Canadian stock is up. But if we actually take a look at the 1 month here, I mean, I've lost 2% on the dollar value, the global purchasing power of that Canadian asset. So if you can own Canadian assets in US dollars, I always recommend that at best because we never know when the Canadian dollar is going to rally back. And if you need capital, we know the U.S. has the kind of unfortunate stronghold over a lot of Canada and Mexico's currency values. Though, again, these tariff wars could affect the U.S. dollar, could affect, and it is. I mean, the U.S. dollar sold off a little bit, not as heavily as the Canadian dollar. But, I mean, obviously, if the U.S. goes into some kind of recession because of this tariff war, that would be, I think, the defining factor to the strength of U.S. assets and U.S. investments is people might start pulling money back out. But we don't really know, right? So we're not going to gamble on that. But I do like having a better exposure to the U.S. dollar because it's been proving to offer much more stable returns. Because, again, even though U.S. stocks go down, if the Canadian dollar in the last 5 days goes down 1%, and let's say, where's the S&P right now is, down 0.32%, because the Canadian dollar dropped 1%, I'm actually up almost 1% on this, which is kind of confusing, I know. But if I own this in US dollars and it's flat, but the Canadian dollar dropped 1% and I sold this back to Canadian dollars, I made 1%, which we should actually be able to see technically in VFV, which is something I tell you guys a lot about. If we take a look at VFV year to date, yeah, I mean, it's up 0.55%, right? So on that dollar conversion difference that's calculated into here. So you got to always keep that in mind. But overall, when we take a look at broader markets, I really think most investors should look at this as purely noise because when I look across the board, Alibaba is still holding up very strong. It doesn't seem to be getting hit nearly as hard in this market uncertainty. Hershey, companies that got absolutely devastated, which, man, congrats to anybody that picked up the dip here. 23% run up. I mean, look at Nestle's up 18%. So you can really kind of encompass the entire market into something with something like XEQT or VT. And you can see that because global markets are actually performing much better, you can get into these ETFs and get that kind of global exposure. So if the US, Canada, or these companies start to falter a bit, whereas China, Alibaba, Hershey, Nestle, some of these broader based mega cap companies start to perform well, they will actually cushion the blow to what's happening in the Western world. So I'm going to keep refining this down, saying that for most of you, I think the best thing you could possibly do is cost average into any weakness on these kind of ETFs like XEQT and VT. Those are just my personal opinions, even though that's not where I'm investing my money. Obviously, I'm a bit more aggressive here, but these are my long-term goals as eventually I'll take gains and I'm going to start building up my position in XEQT. But I've talked to you guys about this before, right? Like I'm trying to get a foundational portfolio built. In my personal portfolio, I want about a couple 100,000 in the S&P 500, about 100,000 in VDY, the Canadian dividend ETF, about 100,000 in SCHD, which I already have. And by the end of this year, hopefully I'll be taking whatever gains I have, if there are gains in Take-Two Interactive, some of my speculative plays, at which I'll convert that over to broader based ETFs into finalizing the positions that I want. But we'll see how it all kind of pans out here, obviously, right? But I mean, if you're into growth companies right now, this is the opportunity. This market will bounce back aggressively if Trump shows to be bluffing and the market does kind of come into that news tomorrow, unless we have true buyer's exhaustion and maybe people are just tired of the uncertainty and they will sideline it for now. Time will truly tell here, but this is a well-needed breath in the market, and I hope you guys aren't getting that depressed by it. Honestly, I think a lot of people in our chat group are like over it. They don't really care. They're like, okay, it's another day in the market here, folks, kind of getting used to it. So I'll pass it off to you, though. Are you used to it? What are you buying? How do you feel about your portfolio? Is this a cause for adjustment? Are you over leveraged, feeling the uncertainty right now? I'd love to hear about all of it in that comment section below.